Hi guys, good morning and welcome to Power Breakfast. I'm Pavitra Parekh. Those are all of the top headlines that we're tracking for you this morning. It is a complete wait and watch ahead of what the Fed is going to announce tonight. The decision will be out at around 11 p.m. tonight, so we're all waiting by for that. But ahead of that, let's quickly take a look at what's happening in the global markets. We did see a negative close on Wall Street, and on the back of that, you have all of the Asian markets which are opening with cuts. What's looking the worst is the Japanese market. The Nikkei index will come up for you, and that one it's currently around 380 points lower, so 1.4% gone on the Nikkei markets. Hang Seng also on your screen seeing similar levels, 260 points lower or 1.4% lower there as well. Taiwan is around 0.6% in the red. And whether you look at Straits, Shanghai, Taiwan, all of them actually seeing cuts between 0.5% and 1% each. So it's definitely quite a negative open for the Asian markets. Remember, this is after the kind of sharp rally that we saw yesterday. So do keep these rates on your radar. The SGX Nifty will also come up for you, and that is indicating a weak start for our own markets. We're currently around 80 points in the red on the SGX Nifty. So that's what's happening across the Asian markets. But let's also talk about the US now. Wall Street ended Tuesday's trading session lower. So the Dow Jones and S&P 500 closed just above 1% in the red, while the Nasdaq Composite ended around 1% lower in the trading session. Now, all eyes are on the Fed decision and Jerome Powell's commentary later tonight. The September CNBC Fed survey shows that on average, respondents believe a 75 basis points hike is imminent, bringing the federal funds rate to 3.1%. Now, respondents also say that the central bank will remain at peak rate for nearly 11 months. CNBC's Steve Leisman is here with a quick wrap-up of all of the highlights from this Fed survey. Steve.
Wall Street increasingly embracing the idea that the Fed is going to hike and hold at a restrictive rate rather than the old idea, which was that it would stop short and then cut quickly. The September CNBC Fed survey finding that 75 basis points is the call for this week. All of our 35 respondents, except for two, who put it at 100, but mostly saying 75. Then that peak rate, the terminal rate, 4.26 now. And that is 40 basis points higher than the July survey. That peak rate is hit in March of 2023. Then the important question we asked this time, how long will the Fed hold there? 11 months is the number, with some saying as few as 3, some saying as many as 24. The recession risk now 52%, little changed for the next 12 months, by the way, little change from the prior survey. John Riding writes, the Fed has finally realized the seriousness of the inflation problem and has pivoted to messaging a positive real policy rate for an extended period of time. That's the important part there. So there's the trajectory. 240 right now, 238, call it. We reach near 4% by the end of this year, go up to that peak rate in March. And then you can see that there is some cuts built in. That's the result of some thinking the Fed turns tail quickly. But the average, again, thinking the Fed stays there and holds, with cuts coming perhaps into 2024. Rates stay high because the 35 respondents think that it takes a long time for the Fed to bring down inflation to its 2% target. We're 8.3 now. We go to 6.8 on the CPI by the end of the year, 3.6 by the end of 2023. It isn't until 2024. Just 60% believe the Fed hits the 2% target. By the way, more than 80% of respondents did not change their inflation forecast over the next 2 years because of the Inflation Reduction Act. Along with the recession risk comes an expected rise in unemployment. Take a look here, what's expected to happen. You're at 3.7 now. Go to 3.8. Not too much damage by the end of this year, but next year, 4.4. It's still an historically low rate, but you often don't see a 1 percentage point increase from the bottom outside of a recession. While these respondents have argued over the past several months that the Fed was way behind the curve in tightening policy, many also now are concerned about the opposite, that it will go too far or further than it needs to go.
All right, Steve, thanks a lot for bringing us all of the highlights from the Fed survey.